For the past couple months, I've been waking up really early to do one thing: check my Robinhood. Now, ever since the COVID-19 pandemic started, I've been really interested in stocks. Overall, my experience in the market has been kind of a roller coaster. There are days when everything goes up, I make a whole bunch of profit, and life feels great. Feels like there's nothing that can stop me. And then there's other days where I lose everything and all my profits are gone. Yeah, those are not good days. But my experience with the stock market got me wondering, is there a way to beat the stock market? A one-size-fits-all, everyone should do this, everyone should invest in this company or that company, and within a week, within a month, you'll be a millionaire. So I went on a search to find the answer to the question, how do I beat the stock market? Now, I had to start with someone who seemed like he knew a lot more than I did. Professor William Simon. Now, Professor Simon is an assistant professor at UCLA. He teaches classes in investing, so it seemed like he'd be the right guy to go to.
So just to start off, can you just give a very short introduction about who you are, what you do at UCLA, what you do just in general?
I'm a value investor. There's lots of different types of value of investing, growth investing, momentum investing. I happen to be a value investor.
Can you briefly describe the difference between value investing and the other types of investing? Like, what makes value investing different?
So value investing basically is different because it looks at trying to buy $1 for 50 cents. Now, other forms of investing, like growth investing, basically presume that whatever your investment is will grow. Value investing, we don't presume it grows, because if you only pay 50 cents for it, if it stays the same at $1, you still make 50%. Or actually, in this case, 100%.
So take the average college student. Let's say very specifically, we have less than $10,000 to invest right now. What is the most specific advice you could currently give me with the current stock market?
You're not going to do crazy stuff that you don't understand. Maybe you might say, I have a lot of Apple products. I'm going to do some reading about Apple. If all the signs are good, I'm going to invest in Apple, but I'm not going to invest all 10 because I don't want to just be tapped out day one. So Ben Graham said he had 2 rules for investing. Only 2 rules. Rule 1, don't lose money. Rule 2, don't forget rule 1.
Now, Professor Simon, he gave a lot of good information there, a lot of good tips and tricks. But he didn't give me anything really specific, like this firm I should invest in. So I decided to talk to Nicholas Martono. Nicholas is the president of a club at UCLA called the Bruin Hedge Fund. And one of the things this club does is debate different investment strategies. So let's go find out what his advice was. What is your advice to people like you or me or any college student who is currently trying to invest in the market? What do you think is the route that he or she should take?
Don't trade, but invest. When you're trading, you're like predicting, oh, the market's in a dip, it's gonna go up. But when you're actually like investing, it's kind of a different mindset, right? You want to put things in for the long term.
What industry right now would you say is a good investment in the long run?
Technology is probably one of the riskier ETFs out there, right? But generally speaking, the one advantage we have over like a lot of other people is time. With technology ETF, you can kind of use that time to ride out the volatility. So from that aspect and how we see technology moving forward, I think that's kind of like a huge position for growth.
After everything Nicholas and Professor Simon told me, I thought I should put them to the test. I got a couple of my friends at the Daily Bruin, and we played a stock market game for 1 month. For a month, we hypothetically invested $10,000 into anything we wanted to, and after a month, we saw who was on top. The 4 stocks I bought with my $10,000 were NEO, FBT, Tencent, and Microsoft. Now, NEO I bought because they're supposedly the Chinese version of Tesla. They were working on an electric car, and it seemed like a good investment. FBT I bought because it's a biotech index, and with the COVID-19 pandemic, it felt reasonable to think, hey, biotech's probably becoming really important right now. Now, Tencent. In case you didn't know, Tencent is a Chinese company that produces applications like WeChat. At the time that we started the stock market game, it was on a low. President Trump announced a ban on Tencent. It caused the stock prices to dip a little. And so I thought, in reality, it's probably worth way more than it actually is currently valued at. And then I bought Microsoft. Microsoft were the leaders to buy the popular mobile app TikTok. And if Microsoft is in the lead to run it, sounds like it could be a huge boost in business. And those were basically the 4 different stocks I bought. I followed 3 simple rules. Number 1, diversify my investments. Number 2, Nicholas told me the tech industry was booming, so I invested in that. And number 3, try to find things of high value. But yeah, after following those 3 rules and buying these 4 different types of stocks, all we could do was wait. Now from the get-go, I was doing so great. I was like, I am the greatest investor. I'm the next Warren Buffett. That's what I'm gonna show him. And then one day, the stock market crashed. At that moment, I wanted to sell everything. But I also started wondering, what role does fear play in the stock market? I try to find the answer to that question as well. I talked to Professor Avishek Adhikari, who is an assistant professor of behavioral neuroscience at UCLA. And I decided to sit him down and just ask him a couple questions about fear in the stock market.
So regarding like financial fear, what would you say is the evolutionary basis of this? Like, why do people fear losing money?
Now, most of our history was in a time of extreme scarcity. You can sort of measure that mathematically, and you can see that people are more averse to losing a certain amount of value than they value the gain of that same amount of whatever it is that you're measuring. One kind of concrete example is if you ask most people that I'll flip a coin and then if it's heads, I'll give you $10. If it's tails, you give me $10. In the long run, the expected value of this bet is 0 because you expect to win half of the time and lose half of the time. So there shouldn't be some strong preference mathematically for wanting or not wanting to do it. But there's a strong preference in average for people not wanting to take this bet. And the fact that you have to gain more than you're losing for people to take the bet is a kind of very concrete measure. People are more risk averse.
Do you think there's a possible way for people to manage fear?
Yes, because so in the financial decision, one thing that you could try to do is just to automate the decisions. We'll buy or sell some asset if the price reaches this amount, and then it just sort of pre-programs. It's not your emotional decision to make at that moment.
So, according to Professor Avi, I can manage my fear. With that in mind, I took a couple deep breaths and I told myself, I'm not going to pull out of the market. I stayed in, and at the end of the game, guess what? Your boy won. Now clearly this was just a simulation with a very small sample size. At the end of the day, I think we're all winners. We all tried our best and it was fun. If I were to boil it all down to a single lesson, I think it comes back to a quote that Professor Simon shared with me.
Rule 1, don't lose money. Rule 2, don't forget rule 1.
And that's how you could beat the stock market. Don't lose money.